Hi all, welcome to Navya Markets Limited. Autoline Industries is our latest fundamental pick. This is from the auto component space. If you see in the past few months, the auto players like Maruti, Ashok Leyland, Bajaj have been facing serious shortage of auto components, due to which their production has been delayed. In some places, production has been cut. Even the lead times for delivery have increased significantly. This huge shortage in auto components has led you know um, has led the auto component players to increase their capacities significantly, going forward. They have planned for huge capacity expansions in the coming years, and this kind of capacity expansion provides strong revenue visibility as well as profit visibility in the coming years. And one more thing is these mainland auto players like Maruti, Hero Honda, Bajaj have moved significantly over the past many months. Even the auto component players have moved significantly over the past few months. But still then, considering this kind of a shortage as I stated earlier, there is a lot of value that is available in this auto component space. And considering that kind of a value, we have picked Autoline Industries. Even though many of the stocks are expensive in this sector, few stocks like Autoline Industries are available cheaply and also having strong growth prospects. And this is the basic rationale, behind picking this Autoline Industries. If you see the credentials of the company has recorded blockbuster performance in Q1 with 240% rise in sales and 740% rise in profits on year-on basis. If you see gradually over the past few quarters, the company has been recording strong year-on-year as well as quarter-on-quarter growth in both profits and sales. And this quarter, it almost peaked in its financial performance. And going forward, also we expect this kind of performance by this company. If it really does, perform on these lines, easily the target can be reached in the next 2 quarters. And one more thing is, even considering the conservative growth estimates with EV/EBITDA margin of 10.5%, the forward P of the company turns out to be around 8.2, which is almost one of the lowest in the industry. Forward P. The company also supplies 70% of its products to Tata Motors on a consolidated basis. The robust performance of Tata Motors over the past few quarters, and also the robust outlook on its revenues going forward, implies strong revenue outlook for Autoline Industries as well. Autoline Industries is basically into contact manufacturing of sheet metal components. That is how it started. Now it manufactures exhaust systems, sheet metal components, brake shoes, assembly of full body frames for passenger cars, SUVs, SCVs, etc. And seeing from the perspective of its raw material cost, the company's prime raw material is steel, and the outlook on steel prices going forward is not that good. I mean, the prices are supposed to be on the lower side because of the uncertain demand outlook in large economies like US, China, Europe, etc. So because of this, the company would be able to record healthy operating margin levels of 10 to 11% going forward. And one more important point is that Rakesh Jhunjhunwala had taken up 10% stake in the company in 2008 around a price of 235 per share and is still holding it. The company's growth over the past few years, past many years, has been very good. It has grown at a CAGR of 30% in volume terms, and in profit terms, it has grown at a CAGR of 12.7% over the past 4 years. The growth would have been still a lot better, but due to the recession and the high raw material cost during 2008-2009, the profits have been hit significantly. The profits have been hit significantly, because of which the overall growth rate has been moderated. If you see the outlook and valuation of the company, the stock is presently trading at 8.5 times its trailing 12-month EPS and 8.2 times its FY 2010-11 EPS. With such valuations, the stock looks really cheap, and even the growth prospects look good. So considering all these factors, we have initiated coverage in this quarter with a strong buy and with a target of rupees 246, that means 25% return from our initiated levels in a 6 to 8 month duration. and these are the projected financials for the company. We have projected on the lower side. The company has projected over 700 to 750 crores revenue for the company in 2010-11. We have taken 700 crores. Even on the operating margin front, we have taken 10.5%, while the management has expected 11%. Even considering these low estimates, we have got a forward P of 8.2, which is, as I already said, one of the lowest in the industry. And the risks include the rise in steep rise in raw material costs going forward. In the same way that happened in FY 2008-9. But that kind of a scenario going forward is not that likely, considering the uncertain environment, demand environment in the economies like US, Europe, etc. And an occurrence of a double depression also can affect its sales. But again, this kind of a situation is not that likely, considering the positive economic data that has been releasing of late. So, having said all this, you know, and also having said all the positive factors earlier, we strongly believe that this counter will reach our target in the next 2 quarters, and so do we recommend this stock with a strong conviction buy, and we hope you benefit a lot from this counter. Thank you all.